All right. Good morning. Good morning, everybody. We made it. It's Wednesday, FOMC day. If you're new to this process, at 2 o'clock, we will get the official statement. And then at 2:30, Powell will come out, chipping his teeth. And historically, there's like four parts to the FOMC when we think about price action, right? The pieces are just the two pieces that I mentioned, but the parts of the price action, we get the initial push at 2. We get another response when Powell starts talking. We get any sort of response during his talk. And then once he wraps up before the end of the day, there's another one. Now, these can all four be bullish or bearish. It doesn't have to diverge between some go up and some go down. Edgeful, I believe, has some really good statistics and reports on FOMC and what it's done historically. You can always check that out, see, you know, how often it's gone up versus how often it's gone down and whatever. When it comes to the rates today, nobody is expecting to see the rates change. Certainly not going up, very likely not going down. They would have been signaling in advance if they were going to cut because they don't want to shock the market, surprise it. They certainly can, right? But that would be detrimental to freak everybody out because if they cut without signaling first that they were going to cut, then everybody's going to start to wonder, why did they cut? What's the problem? Was it an emergency cut? Are they trying to front run something really bad? And it's just going to scare everybody. So they won't, very likely wouldn't do that. And since they haven't signaled it, we're not going to get it. We're going to run with status quo. So what will be more important rather than, do we get a cut or not, is what Powell has to say. There's no changes to the dot plot for this meeting. So, that's not on the table. It's just going to be on Powell. And he's going to be talking about the same thing that he's been talking about, which is we don't have enough data to make a decision to move the rates at all. Things look steady, so we're going to just stay the course and wait. And that's going to be the messaging. I like to say it's Operation Don't Rock the Boat, right? He's got to talk for 30 to 45 minutes without really saying anything. Maybe a skill, right? To just sit there chipping teeth without actually saying anything. So we'll see how it goes. If he, chews on his own foot, gets caught up in some questioning and gets misquoted, there's always a risk or a threat, right? That he can be misquoted, misunderstood, and the markets respond in a negative way and then have to overcorrect and move back in the other direction. So we'll just see how it goes. But it's not expected to be Revelation Day, right? We're not going to get a lot of answers because he's not the one that we need clarity from. Small caps up the most, very close to 1%. The Dow behind that, then the NASDAQ, and then the S&P, all up more than 0.5% this morning. But that's really all we got. If you think about the rotation from around the world, Asia, and then Europe, and then us, everybody else is flat or down. Everybody's just sitting out, waiting. We do have Japan's 10-year bond in the overnight hours. If you're, if you're awake, trading in the futures at night, keep your eye on that bond auction. It's very likely going to be something that you see it, you'll feel it. Other than that, it should be pretty boring after FOMC until we get to the later part of the week. As you can see, they're all going to want to come in here and start having their go at it. Plus, we're going to get some jobs data on Thursday. $50,000 in the overnight. That's really pretty light compared to what we've seen in the last month or so. The base case argument as we came into Monday is that we were going to hold the range, and the range that we were going to hold was Friday's price action. That was the argument that I laid out on Monday, is that we'd probably just stay in this range, and that even if we did leave the range, we would very likely just wick out of the range, come back in to close inside. This isn't about me pointing out saying, see, I was right. Broken clocks are right at least twice a day. The idea that we can develop a theory, a game plan, and have a bias for what we expect price to do based on what it's done before, based on the volatility measures that we had for this week that told us the market itself was expecting a sideways week. On these sideways weeks, we get sideways days. They're choppy. The trades don't follow through very well. They are opportunities to trade, right? If the market's open, you can trade it. But if you're newer to trading, you probably found the last 2 days tricky, difficult, confusing, frustrating. I've heard quite a bit of it over the last few days from people that are just really struggling with this price action. It's FOMC week. If you don't like what you've just seen over the last 2 days, then you know the next FOMC week, find something else to do, right? Don't waste your time trying to trade in price action that doesn't suit your style, because this is what you should expect on holiday weeks and FOMC weeks. Very likely on big holiday, big events other than FOMC, right? When you got QRA or even non-farm payrolls. It's not like you can't see this stuff coming from a mile away, right? It's on the books. We know where it is. We're still hanging out with volatility trigger and zero gamma. The call and put wall, long ways off. No change on either one of those. We continue to hold the sideways range, waiting. And if we were looking for a pullback to set this higher low, technically we got it, but I would have expected more than what we did get. Maybe we get more, maybe not, but this isn't much of a pullback. Now, on one hand, when you've got price action that is strong like this to the upside and we pull back, a shallow pullback just implies that this strong run that we had isn't done, and that everybody was willing to step in and take the place of those that were leaving from profit sooner than we expected, right? That we didn't get as much profit taking, and that we had people more than willing to take their place. So it's aggressive to not have as deep of a pullback as we expected. But it was already a really big run. We don't want it to get overextended and then, end up with some mean reversion behavior because of it. There was a headline about meeting with China for talks that popped us last night, created a bit of a liquidity gap. You can keep your eye on that one. It's really close to 56.11 cog line. And that basically got us up to the ADR half, 56.92 cog line. if we were to set that back to a 5-minute and then measure that 5-minute candle, just like we do on non-farm payrolls, CPI, PPI, we get that big event bar, mark the 50%, measure that bar off its high and its low, project the 111 and the 1236. You can see we're still holding above the half. So if we fail that half, then the target is 5608 or 5611 cog line, which is really close to yesterday's low anyways. And the measurement that we have here is not much different than the measurement we have for yesterday's price action. So it's still a big halfway mark. If we break the halfway mark, whether you use that big candle or just measure yesterday, if you break the half, we're going to yesterday's low. Short and sweet and simple. And if we break that, then we've got the 111, the 1236, and we can expand to the downside. If we try to retest the upside, we've got 5692 cog line, which is in front of a big round number, 5700, and very likely where we stall out because we don't have an expectation that we're going to break 57 before FOMC. After Powell starts talking, sure, we could do anything at that point. So we are closer to the upper ADR than the lower. As long as we're holding above that halfway mark that I just pointed out, that it's more likely we go to the upper ADR than the lower one. But those two red lines are what we have been moving on a day-to-day basis, that sort of distance. It's worth keeping that in mind, and how fractured it is because of this big bar and because of the drop right before the close. If you think about the distance of that red bar, it's based off of this level here, this 5608. So it at the open, the SPX and the SPY, which gets ADR at 930, they're going to be in a completely different location. They'll still be really wide, but they'll have a different setup than this. It can cause some confusion on the intraday. If we start running, say we break out of yesterday's high and really start going, run through that ADR and get to moving, keep your eye on the SPX and the SPY and look for them to hit their red line to see the ES stop moving in whatever direction we go. It's a bit confusing, right? But they're all the S&P. They'll all have a reaction at their ADR. But if the ES is already past its ADR, then just watch the SPX and the SPY. Use it as a gauge or a tell. Otherwise, it's a really boring morning. We don't expect much of a reaction in price until after FOMC. So more of the same of what we had yesterday and what we had Monday. Choppy, violent, quick reversals on headlines, flipping right back again where we came from. Today's floor pivot is right on top of the weekly floor pivot, 5632 cog line. It's lower than yesterday. That's bearish. Price opened underneath it, and that's bearish. It's not an MDP because we cut through it right at the open, but we are holding above it. And if we were to focus on where the S1 R1 is, I think we've already rejected off the R1. Now we're through R1 and holding above it. There is a floor pivot strategy that focuses on rejecting from an R1 with a target at S2 or rejecting off an S1 with a target at R2. But we didn't reject off of it. We cut through it completely and we're holding above it. And that kind of opens the door for us to go to R2. If we break our own Globex low and get through that halfback that we've been talking about, 5632 cog line is the weekly floor pivot. It's the daily floor pivot for today. And it's the next stopping point. It would be the last thing that could hold us back from getting to yesterday's lows. So If we break the half, yesterday's low is the target. Just be mindful of that 56.32 area, which you should be anyways because it's a cog line. We still got last week's point of control, 55.50. So once we break Friday's low, Tuesday's low, whichever one of those you want to focus on, it's the same thing basically. Break 5,600, we aim for 55.50. Got a nice shallow area that we should be able to drop through into a high volume node, and that would be the next stopping point. If we don't get caught there, it's another 50 points down to 5,500 and a point of control from 2 weeks ago. This week's distribution is just the D-shape classic distribution. It's a little ugly along the edges, but basically it's the D shape. So getting back to the top, just cutting through the value area high and expanding to the upside. The nodes drop off and get more shallow as we climb. 56.92's got a little bit of structure. It's a cog line, so of course we would have a little concern there. But other than that, 5,700. And it's where we've already tried this week. We wasn't able to do much with it. Evening star reversal, big leg down, classic rally base drop. That sets us up for the proximal and distal lines. And there's your zone. Simple enough, yeah. $10-day, 30-minute volume profile with TPO. The TPO shifted up. So the point of control is highlighting here where our point of control on the volume profile is very likely going to go next. If you look at the TPO's profile, it's really clean compared to the volume profile, which is a lot more nasty. It's just really distorted. So the expectation is we're going to see this point of control move up. It would be better if we were above it when it got there. If we are underneath it, then we're going to have to work our way through it to be able to go higher. Now, there is a bit of a zone or a range when it comes to these. If we're holding within a range, we can cross back and forth through that zone, and it won't really act as support or resistance. We can just cross through it. But the risk is if we expand too far and then we try to come back into it, it'll act as a resistance or it'll act as a support, depending on which side we came from. So when this point of control does move up, as long as we're just chopping within that zone, it shouldn't be too bad to get above it, right? If we're below it, it would just be better if we were already above it to begin with once it got up here. The textbooks will tell you to carry forward into today's price action, yesterday's point of control, the value area high and the value area low. For me, I really only carry these forward if they have not been hit yet, right? And since we had that big pop right at the open last night and we moved through that, it's already been hit. I don't want it. But it's not to say that it doesn't have any value, right? These ones that I do have marked, I keep them because they haven't been hit yet. To me, it's unfinished business. We could see a response in price when we get there. It's very likely that if we get to yesterday's point of control, you're going to see a response there, right? It's worth having it on your radar on a day like this when really, we cut through it so fast at the open on that news, on that headline, that there's very likely still a lot of unfinished business. And if we get back to that level, it's very likely that traders are going to reassess their positions. We don't want to put a lot of bias into that line and say that it's bullish or bearish, or that the traders within it are bullish or bearish. We can say that that's where the greatest amount of trading took place yesterday, right? It's highest level of volume at that price. And we can anticipate traders reevaluating their position if we get back to that spot. From a simple logic, if you got in yesterday at 2 o'clock and the next day you find price right back to where it was when you got into it, aren't you going to reevaluate your position? Probably, right? Maybe you do something with it, maybe not. But that's the idea behind it. And that doesn't require any bias to say it's bullish or bearish. It's just a level of interest. You want to know where it is in case we hit it. We start to see a response out of price, we'll understand why we're seeing a response in price. Otherwise, we have a classic P-shape profile this morning. Still holding above the 10-week, steady. The expectation is we're just going to chop above and below this until we get a news event, a macro event, a driver that takes us away from that 10-week. Price very likely isn't going to get away from that 10-week on its own, not in this environment. So we need something to galvanize us and get us moving. It might be FOMC, but we're not really expecting FOMC to provide much, right? That's not the clarity that the market's looking for. So unless he really messes it up and gets to chewing on his foot, I don't see that Powell's going to be the mover. It's going to very likely have to come from something else. Looking at the 10-day, more than 1% means we're very likely out of that gravity or that zone range where we can get just stuck around the 10 and chop. So we are above it. We can begin to expand farther away, get around 2, 2.25. So we're just working on this wave. This histogram down here, it doesn't look much like a wave, but that's how we want to approach it, right? It's just this wave. And we were on our curve down. Now it looks like we're beginning to curve back up. It doesn't owe us anything, just a gauge on how far away from the 10 we are and whether we're moving back towards it or not, and if we're overextended or not. Obviously, we're not overextended. And even with a sideways day for 2 days, we are moving away from it. This week's range was one of the tells that the week was very likely going to start out sideways, right? That there wasn't an increased distance or range compared to last week's range. That's just one of the tells that we used, but it was just slightly smaller. And last week we had a lot of stuff going on. So with a lot of stuff going on last week and then a big old event like FOMC this week, if the market was pricing in a move, the range would have been bigger. It wasn't, it was smaller, implying the market wasn't pricing in a move. The market was pricing in sitting on our hands for 2.5 days while we wait for FOMC. Because FOMC is a volatility suppressing event. So let's get the data and see how it goes. 58.26 is the week's range on the upside. We can easily do that in 1 day, right? Make no mistake about it. We can make that entire jump in one shot from the low all the way to the high on an FOMC day. On the other hand, if things do turn negative, then 5,400 is on the table. It's last week's weekly low. 54.32 cog line, overshoot that into 54. I still don't think we're going to close this gap down here, not this week, unless something really bad happens at that press conference. The gap should stay open, and we should go into the close at the end of the week without having hit that. Gold miners are down, China's down. Really, that's what we got. China and gold miners. There's really nothing else that's down this morning at all. You know, normally we say not down enough, not down at least 0.5%, but it starts at 0.5% with emerging markets. That's China. K-Web's China. MCHI, yeah, it's China too. Yen, that's China. So it just leaves the gold miners and junior gold miners. The VIX is down too, but just set that aside. China and miners down. So we would expect on the other side to see a lot of things that are up, and we do have a lot of things that are up, but there's just a lot of stuff here in the middle that isn't up or down. That can be because it isn't getting any flow at all, right? So it's not sideways price action, it's just not getting flow. So banking, retail, transportation, real estate, some junk bond, cloud computing, oil and gas exploration, airlines, jets, construction, all that just sideways, not getting any flows at all. We look at what's bullish. We've got these sectors that we want to look at for a bullish day or a bearish day. It's our risk on sectors: finance, technology, consumer discretionary. Now, tech is vague, it's broad. It can be communications, which we have up. It can be chips like SMH, expanded technology, the MAGs, which is just the MAG 7 group. There's our chips. So when we say tech, you know, it's kind of generic. We can find all of these different tech sectors, all of them up this morning, especially the two big ones, chips and the Magnificent Seven. Those two alone can break us to the upside and get us ripping on a sideways day where we're waiting for FOMC. Low volume days doesn't take much of a push to get it to move. So be careful of a breakout today. And there is precedence for this, right? This wouldn't be the first time where we go into a Wednesday morning in front of FOMC and we think, it's a sideways day, we probably won't do much. And then we just explode and move all the way to lunch in one direction. In this case, it would be a direction to the upside. We've got every signal for that to happen. Bitcoin up more than 2%. That's a risk indicator, and it looks like they're more than willing to take risk this morning. And then chips right behind that, with Mag 7 behind that, and banks and growth. Yeah. Communications. We've got everything we need to do this. So the base case was that we would come down, break the half, and maybe get that liquidity gap done. But with this much bullish exuberance in the pre-market, we could very easy just run right back up, break yesterday's high, break our own Globex high, get a new high on the week, and begin to expand to the upside. If we do that, go back to Friday's price and lay out a 1, 2, 3, 6 above Friday. 57.38, 57.54. Not expecting that to happen, right? Just to be clear, that is not what today is supposed to be. Today is supposed to be a sideways day where we hold the line. But can't argue with the idea that we've got a lot of things that are bullish this morning, and they are the bullish things that we would need to be bullish, right? It's not like we're looking at semiconductors and pot stocks. Because if those were the bullish sectors we had, we wouldn't care, and we would not be looking for a bullish breakout. There is a little bit of concern that we have those sectors that we want and the names that we would expect, and we're not getting more movement in the pre-market, right? If it was so bullish, why isn't it already moving us? I don't necessarily have an answer for that, by the way. I'm just throwing it out there as a reason to perhaps proceed with a little bit of caution. It's not just the miners that are down, it's also the precious metals. So gold, silver, they're also down. So we got our levels. I'd run it that way, level by level. We got Friday's halfback, 56.63, basically. If we break above that, target our own Globex high. We get above that, target Monday's high, just level by level, right? Run it on up. And the other direction, break back down through the Globex low or the halfback of that big bar into the liquidity gap and then outside of the bottom.